Hi, everyone. Thanks again for tuning in to another episode of Our 2 Cents on Your Dollars. I'm James Enriquez.
I'm James Credo.
And we are here with
Alexis Villarreal.
And Leo Chang.
Okay, boys. Feminine hygiene products.
Okay.
Vitamins, sunscreen, prescription sunglasses, and best of all, cold plunge. What do all of these things have in common?
Alexis.
Yep.
I use them all.
Just in case. They are all medically used accessories and things that you may need in life at some point.
They're all things.
If that was a fill in the bank question, you would have gotten that wrong. But if that was a multiple choice one, you might have gotten that one right.
Yeah, all the above.
Yeah.
D.
Keep guessing. So you have 2 strikes right now.
All HSA eligible.
Hey, ding, 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 ding.
Woo!
Well, okay, hold on.
Dang.
What's an HSA?
Health savings account,
Okay.
I think.
All right.
Yeah, it's a health savings account.
So you're telling me a cold plunge is health savings account eligible?
From your spam inbox? Yes. That's exactly what it is.
Yeah.
Apparently all you need is a note from the doctor.
Okay. So Leo alluded to this. This all came about because I got an email that said cold plunge is HSA eligible, sent me down a rabbit hole. And it's true. As long as you have a letter of medical necessity, you can purchase a cold plunge with HSA funds. So the remainder of this podcast, we'll talk about what a health savings account is, the features and benefits. We'll also talk about its closely related cousin, FSA, flexible spending accounts. We'll talk about some planning strategies around it. And yeah, so we mentioned HSA is a health savings account.
Yep.
What is it? How can you be allowed to contribute or have one of these?
So a health savings account, HSA account, they can be available to you in your employer sponsored type of plans. If you're a business owner and you have a high deductible health insurance account, you can also participate and save into an HSA account. That's the main primary thing that you have to have is that high deductible insurance plan to be able to participate in. Because
And they typically know that they're in that because they're typically paying a lot more at the doctor when they go to it, correct? They don't have co-pays. There's some different things along the lines that will make it pretty clear that they have a high deductible plan.
Yeah, there's a couple different factors. I think the best way for you to know whether you have a high deductible insurance plan is just ask your employer. Go to HR and ask them, hey, the insurance plan that we have, is this an HSA eligible plan? In a lot of circumstances nowadays, these employers are providing HSA accounts with your benefits, so you can participate in those types of accounts with your employer there anyways. So,
And I think even sometimes some employers even give some sort of contributions to it as well. And so those are all important things just to ask your HR individual if you are eligible and if the company is giving any sort of matching or some sort of dollar amount towards it.
Okay, so why would I want to put into one of these?
You know, these accounts are designed specific to cover healthcare or medical expenses. And once I talk about the features, it will kind of remind people, this sounds like a retirement plan. These accounts have tax benefits that can help you from today's taxes, but also in the future. And so with health savings accounts, when you make a contribution, your contribution is tax deductible. And in the account, you get to pick different investment vehicles to grow the account over time. And when the account is growing, it's also tax deferred, meaning you're not paying taxes on the growth or the earnings. And in the future, when you decide to use the funds for eligible healthcare expenses, your contributions and the earnings are all tax-free. And so, yeah,
triple tax benefits.
Tremendous
Triple tax
benefits.
And the dollar amount is before you can start investing in HSA accounts?
You have to correct me if I'm wrong. I think it's around $3,000 for an individual that you can contribute. And maybe, I think I have $4,100.
I think what he was referring to is some custodians require that you have some cash in your account before you can invest.
Correct, right? It's like 1,000, isn't it?
They're all different.
They're all different. Okay.
Yeah,
Varies.
Yeah, it different. It's all different depending which custodian you choose.
Right.
Yeah.
But I think we should back up though, because
Yeah.
you mentioned earnings.
Yep.
So how does that work? Like what earnings are you referring to?
Right. Inside these accounts, just like similar to retirement accounts, you pick the investments that you're going to use to hopefully grow the account. And so the majority of them will have mutual funds to choose from, which can be invested in stocks, bonds, or a combination. And so, for example, if you're investing, $5,000 into the account and it grows to $10,000, that $5,000 in growth is tax deferred, meaning you're not paying taxes on the growth as long as it's in the account. And in the future, when you're at least 65, what your contributions and the earnings, when you're using it for healthcare expenses, it's all tax and penalty free.
Yeah, I think it's even tax and penalty free today before you're 65.
Yes, it is. And that's a really good point, because you have to be careful there. If you're not at least 65 and you don't use it for eligible expenses, and I believe that the penalty is 20%, which is pretty big percentage.
But you can still use it today for any other healthcare expenses that you may have, like a cold plunge.
Yes.
Okay, so all right, so you bring up an interesting point.
Yeah.
Like, should I be spending my HSA money today?
I think it depends, right? I think it depends on what are your yearly needs. What are your, is it a big cost, small cost? I think that, if we go back to Credo's example of this being almost like a retirement vehicle, I think most people can comprehend that there is a high likelihood that they will be using money of some sorts to help pay for healthcare costs in retirement or at later stages in life. And so if you have the cash flow and you have the cash to pay for your healthcare expenses, that could make a lot of sense. I think it goes back to, it depends on what their situation is. But if you don't have to use it, it's a great tool to utilize down the road.
I think with conversations we've had in the past about the benefit of Roth IRA and the significance of the tax benefit, this is a vehicle that does even more than what a Roth does, right? So if the idea is to utilize something that has such a significant tax benefit, then what an HSA provides you, the long-term benefit of that is so significant. So and from my point of view, if you can pay for whatever medical expenses you have with cash flow and you have that cash flow, I think it's such a valuable asset to have growing over time, with the deferral part, and then with the tax-free distributions that it provides.
Yeah, generally speaking, working with our clients over time, when you do an analysis on their expenses over time, healthcare costs for them does go up as they get older during retirement. And so as a rule of thumb, when you're younger and if your healthcare expenses are lower, we recommend that you pay it out of pocket and contribute into an HSA, and as much as possible, keep it there. And this is where financial planning really, it's always tied together, because, right now the markets are up. And so as a practice, we like to tell our clients, keep 3 to 6 months in your emergency fund. And, when investments are up, they'll usually say, James, it's not making as much as my long-term investments. And this is where financial planning always works together, where when you have short-term needs come up, you have an emergency fund where you can keep your long-term monies long-term, like your health savings account, so you can continue to have it grow. And it's a bigger account when you actually need it when you're older during retirement.
65 is such a big age, and there's obviously correlation to why that is a benefit and why that has a significance when it comes to HSA. Because that's Medicare age, right? And so one of the factors we didn't discuss earlier was if you are taking Medicare, you cannot contribute to an HSA. So 65 is such a big age in the fact that you can no longer contribute if you're taking your Medicare at that age. So one of the things we do discuss with clients is the possibility of deferring taking your Medicare, especially if you're already sponsored by your employer for your insurance, for your health insurance, then it may be a consideration to wait and take Medicare and be able to continue to contribute into the HSA account. But if you are taking Medicare, you're no longer contributing to HSA, you have an HSA account that's grown over that time frame, 65 is a big age as well, because you can take distributions out of your HSA account that are not qualified medical distributions, and all you do is you pay ordinary income tax. There's no penalty. So that's a big age in the fact that Medicare becomes such a prevalent part, and then your eligibility and what you can do with your HSA is such a big age at that point.
Around that age, right? So a lot of our clients were business owners, sold their business early, pre-65.
Yeah.
So now they have to go onto the exchange, get a policy, because they no longer have health insurance through themselves, their self-employment. And I was shocked to learn that you can still contribute to an HSA if you're enrolled in an HSA eligible plan, even if you don't have earned income. So I bring that up because we compared them a lot to IRAs, right?
Right.
In IRAs, you need to have earned income to be able to make a contribution. Well, HSAs, you don't need to.
God,
so if you sell your business at 60 years old, you can still contribute to an HSA for the next 5 years as long as you're enrolled in an HSA eligible plan.
Yeah.
So I think that's a huge benefit.
This gets sweeter and sweeter.
Yes.
It really does.
Okay, but I'm a little confused.
Yeah.
Okay.
You mentioned using it later.
Yeah.
I thought we had to use the dollars every year.
I think you're referring to the FSA account, right? Which is a flex spending account. And so as I've done plans with individuals that have ongoing healthcare needs, and they do have options for both of these, what we try to do is minimize whatever their FSA contributions are to whatever their annual needs are, because in those flex spending accounts, they have to spend every dollar before the year ends. I think they have a little tagline behind it, right? Use it or lose it. And so in some options, employees or individuals will have an option for FSA accounts and HSA accounts. And this is where the planning comes in, to where we can try to adjust the numbers to where we're maximizing the HSA account and minimizing the FSA contributions.
Sounds like it's not really flexible.
It's just a catchy
If you
name.
don't use it, you will lose it.
That's the flex.
That's just the way it goes.
That's the flex.
Who makes this stuff up?
yeah.
If it's in the name, you probably should question it.
Too good to be true.
Awesome juice. How
Yeah,
awesome could it
awesome.
really be?
I think a lot of employees have complained about that, because I think some plans, I think it depends on the employer. They do have a grace period, I think up to 2 months the following year to take out that money. And I think you can roll over even a portion. I think for 2024, it's like $640. So I think it's their way kind of just making it a little bit more flexible. I can just imagine people maybe not being aware that you actually have to spend it down, because that's such a weird feature you don't hear a lot, in this free country where you give your own money. Wait, if I don't use it, it goes away. So
You should check your emails in December, right? That's where you get hit with the spams on, hey, your dentist calling you, telling you need to use it before the end of the year, teeth cleaning and stuff like that. Right? I feel like that always happens at the end of the year. There's a push from the medical industry. Hey, you need to use those plans. Come see your eye doctor, whoever it may be, just because, right? They already know that there's money out there that's going to get lost, and so they try to grab it before it goes away. Right.
And I think FSA contribution limits are lower as well. Is that correct? Yeah.
And no investment capability.
I guess you don't need to invest money that you're gonna spend in 14 months.
Have to spend it.
Hey, money market accounts is up.
I think we also mentioned it's only available to the employer.
Right.
Yeah.
So payroll deduction.
Right.
Payroll deduction.
Right.
So HSAs you don't have to do through your payroll deduction.
Right.
So what happens if we're self-employed, right? Our plan doesn't offer an HSA. So what do I do?
Yeah, I mean, a quick Google search will provide you with multiple financial institutions that'll help provide HSA accounts.
I think we have several local banks around here, right, that we kind of refer people to and have them open up the accounts through them. And it seems to be a pretty simplistic process. If I'm not mistaken, I think most of us have walked our clients through it at one point or another.
Right.
Yeah. Walk them through the account opening process, and as well as helping with asset allocation and the investment aspect of it as well too. But it's not difficult. And there's a significant amount of financial institutions that provide that. They're not. It's interesting because they don't really market that they do that.
It's a little secret.
Yeah, it is strange because I've spoken with clients before, and they're like, oh, I didn't realize my bank has that available to them. So that's that's something that's not difficult to do, and you can do that. If your employer doesn't have it, you can still contribute to it outside of the employer plan.
So what are some things I should consider when looking for an HSA provider?
I say accessibility, or the aspect of how convenient it may be to open up. Whether it be if you have a local banker, or you want the process to be as easy as possible, and the options to match whatever it is you're trying to do. Right. So some financial institutions will have limitations on what investment options are available inside of the health savings accounts. Right. And so again, I think that goes back to risk. Right. So knowing your client, knowing what you're trying to do, I think we'll have some factors in this.
I know my clients. One of the reasons why my clients switched their health savings account to another institution was because they didn't have a debit card. So some of the institutions won't provide you with an actual account card, a debit card associated to the account that they'd be able to use at, a Walgreens or, a CVS or whatever.
Or Cold Plunge.
Yeah, to purchase. And so that was inconvenient for them, and which made the most sense. So then that was a big reason why they ended up switching to another institution that provided, the debit card to be able to use.
So if you don't have a debit card, how do you get the money out?
The account has an account number, so it's like a checking account. So you can request distributions out, or you can do some type of ACH. Well, dyslexia today. ACH distribution out of the account.
A lot of those custodians that don't provide a debit card require some kind of proof, right? Like a receipt.
Some sort of medical bill.
Yeah. They'll require something to show what you're
right.
purchasing it for.
Sounds like a fun process.
Yeah, it's annoying. I bet.
Please justify.
I wouldn't know
this.
because I don't use HSA account currently. I'm deferring it over time.
Okay, so I'm glad you said that. All right, then my question goes to you, sir.
Yeah. You fine, sir.
You lucky one.
So this is addressed specifically for you.
Yes. Okay. Well, if you have no intention of using it, should you request a debit card?
You just don't know. I guess if something could come up where you might have to utilize it for an expense. But I mean, if you don't need it,
come on. Imagine you're at a party. Everybody's talking about their adventures, their fine wine.
There's nothing more impressive than showing that HSA card.
You whip it out
and like, hey, look at my HSA debit card. Do you have one?
Well, where's the affiliate link on your debit card?
One of the interesting things taking consideration though is what happens to your HSA over time, right? So if you pass, what happens to your HSA account? So we've gotten this question because you do designate beneficiaries for these accounts. So typically what happens if you are married, your HSA account would transition over to your spouse. No problem. They would continue to inherit the same benefits that you were receiving when you owned the account. When that spouse then is deceased and then the benefits are then transferred over to non-spousal beneficiary, that HSA at the time of death now ceases to exist. And so the individual who then receives the benefit of the HSA account at that point in time receives all that money as ordinary income to them for that tax year. So at that point in time, they have to pay ordinary income taxes on whatever is remaining in that account. So that's an important thing to think about. When it comes to later down the road, right? You are in your retirement years and you're like, oh, I'm just going to let this ride forever. I don't want to take anything out of it. Well, Uncle Sam's going to get their tax dollars at some point in time. So medical expenses are expensive at that point in time. Now it's definitely appropriate to start spending it down.
I think important things also too is just making sure your plan, right? If it's an individual plan or family plan, that also impacts your contribution limits to your health savings account. If you're a family plan, you can contribute a max. If you have an individual, right, you're the only one on it, you have a little lower limitations. I think it's important to really try to figure out what it is you're trying to do, right? As far as what options you want in the accounts and accessibility.
Okay, so if two spouses are not on the same plan, but they're both in HSA eligible plans, can they both contribute to an HSA?
Yes.
Yep.
Okay. Cool.
Absolutely.
I think one of the other things I like about HSA contributions is that they're above the line deductions.
Yep.
So they reduce your adjusted gross income, which can have a bunch of other ancillary benefits.
Yeah, we don't have enough time to list them all.
Yeah, I think we have in a different podcast. Shameless plug. Something I like to touch on is the fact that most high deductible health plans are actually less expensive. So if you're paying out of pocket for your health insurance premiums, then you're actually saving money. And you make yourself eligible to contribute to an HSA, which is also going to save you some money. And usually I like to tell folks, especially people that are similar to us in age and familial type, where you have young kids that are fairly healthy. You just go for your annual checkups and minor things here and there. That high deductible health plan may be appropriate, because I think one of the biggest pushbacks I get is people don't like paying when they go to the doctor.
That's always what I gotta pay money. I can't just pay a copay of $25.
Right.
I think that's a big hang up for most people, is that they can't get over the aspect that they might have to pay a couple, $100, $200, whatever for that office visit, compared to the copays. And I think that's a little bit of a hang up, but I think going through that work through with them and showing them that they can actually probably pay less if they go through the high deductible plan, it's a hard thing. And then I think sometimes they also get kickback from some of their employees if they have employees. I think most employees don't want to pay anything more than the copay. But again, I think each scenario has its benefits.
Yeah, you know what? You bring up a good point, because whenever I talk to our business owners, they'll say something like that. And so what I like to remind everybody is that each individual can choose the plan that they're on. So if you're the employer, if you're the small business owner, and you make a health insurance plan available to your employees, you give them a menu of options. And what we say is just consider putting one of those options as an HSA eligible plan. Nobody signs up.
Right.
But maybe you'll be able to. So any other parting words on an HSA?
No, I mean, it probably is one of, if not the most efficient tax vehicle in the investment landscape.
I think it's underutilized, right? Because I think a lot of times we get these scenarios of individuals doing all sorts of planning for long-term care needs, healthcare needs, and retirement. And they go through all these fancy vehicles of using life insurance, real estate, investments. They do all these different things instead of using a tool that's specifically designed for healthcare cost. And when you start looking at the cost of some of these other investment vehicles, they're after-tax dollars a lot of times. And so they're missing out on all these today benefits and tomorrow benefits because someone sold them on some sort of grand scheme about how this is going to impact them. There can be a whole lot more efficient way and cheaper way to provide the same needs and coverage that you're looking for, and also have a lot more flexibility with it.
When I'm 65, I have a cold plunge and sauna.
I got the sauna now.
And all my ED medication is taken care of.
I'm just mad that I didn't use my HSA account to buy my sauna.
No comment.
In case you didn't catch that, yes, saunas are also HSA eligible with a letter of medical necessity. Please consult your healthcare professional, your tax professional, and your financial professional. Thanks again for tuning in. That's our 2 cents on your dollars. Make sure to subscribe and follow, please.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to effect some of the strategies. Investing involves risks, including possible loss of principal.